Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. We are diving into a deep dive today that unpacks, well, a truly bizarre market environment.
Definitely. You've got this AI-driven U.S. stock market hitting fresh records.
Right.
It feels like a honeymoon rally.
But then, bam, you see these immediate, really dramatic policy shockwaves hitting key global sectors.
Yeah, from tech staffing to, big strategic investments. That tension, that's really the core story in almost every financial source we looked at this week, wasn't it? CNBC, Bloomberg, all the columns.
Absolutely. So the central question we're tackling for you is, well, how long can this bullish feeling last? I mean, when you have multiple pretty measurable geopolitical and structural risks just flaring up everywhere.
Right, all at the same time. So our mission today is to try and synthesize these sort of conflicting signals.
We need to unpack the arguments for these record stock prices, figure out who's really benefiting from the AI boom.
And detail the immediate impacts, right, sector by sector, from these new policy decisions, especially around, like, human capital and cross-border money flows.
Yeah. Okay, let's start right there with the U.S. market rally.
So the Fed delivers its first quarter-point rate cut of the year, and boom, the S&P 500, the Dow Jones, they surged to fresh records. Yahoo Finance and others reported on this.
Kicking off what everyone's calling this short-term honeymoon rally, investors just celebrating easier money, basically.
Yeah, optimism about financial conditions easing up.
But the fascinating part is justifying the price. We're talking S&P 500 around, what, 23 times forward earnings? That's historically steep.
It is. But you have Jeff Krumpelman over at Mariner Wealth Advisors arguing, look, this is totally justified. He points to strong earnings prospects, all driven by these AI-fueled productivity gains.
Right, he had that great line I saw paraphrased in the sources. This isn't your grandfather's S&P 500.
Exactly. His point is that past cycles, they had lower return on equity, thinner profit margins, because the index wasn't so heavily dominated by these massive tech and communication services names.
The ones using AI to fundamentally change their business models.
Precisely.
Okay, if Krumpelman's right, and this new S&P really does have structurally higher margins, higher potential returns, doesn't that justify a higher multiple, even if it looks like speculation to some?
And that is the absolute crux of the debate. It leads you straight into the bear case.
Which is?
Well, Ed Yardeni, his comments were in CNBC's analysis. He warns that cutting rates now, when the economy is still pretty healthy, that risks just fueling speculative froth, driven purely by investor FOMO, fear of missing out.
Not fundamental.
Not fundamentals. And historically, those kinds of run-ups, they often end badly. Sharp corrections.
Emily Rowland at John Hancock put it nicely, I thought. She described the environment as unusually favorable but fragile.
Fragile, yeah.
And she noted the market has selective hearing right now. It's only hearing the rate cut as good news for stocks.
Ignoring any warnings about inflation or maybe why the Fed felt the need to cut in the first place?
Exactly. And if you look at the bond market, there's definitely some skepticism there.
Oh, yeah. CNBC reported that yields on 10-year and 30-year treasuries actually rose after the Fed cut.
Which is totally counterintuitive. Highly counterintuitive. It suggests bond investors, the usually skeptical ones, they weren't convinced the situation really warranted easing. Maybe they're pricing in future inflation risk instead.
Meanwhile, gold's holding steady too.
Yeah.
Fifth straight week of gains.
Showing investors are still looking for those traditional safe havens, even with stocks rallying. There's underlying unease.
Okay, let's shift gears. Where is the AI money actually flowing? Because this is where it gets really interesting.
It really does.
Yeah.
The AI euphoria, it's spilling way beyond the usual suspects like NVIDIA.
Into what Bloomberg called the typically boring tech sector. Yeah, boring no more, apparently. I mean, the numbers this week were stunning. Seagate Technology, hard disk drives is the best performing stock in the whole S&P 500 this year, up 156%.
Wow. 156%.
For hard drives. And its rival, Western Digital, up 137%. And Micron, the memory chip maker, surged 93%.
So why now? I mean, hard drives, memory, they've been around forever. What's changed?
It's the sheer scale, the amount of data needed for training and running these large language models, these LLMs.
Okay.
They don't just need fast processors. They need massive amounts of cheap, reliable storage for all that training data. And they need incredibly high-speed memory, HBM, to feed data to the GPUs quickly.
So Seagate and Western Digital, They're like the plumbing for the AI data centers.
Exactly. Foundational infrastructure. And that relentless demand for capacity, that's what's driving these huge valuations,
Mhm.
even for what seems like older tech.
Now, Michael O'Rourke sees this differently. He thinks chasing these secondary and tertiary trades might be a sign of a very late stage in the cycle.
Mhm.
His argument is investors are looking further down the food chain because the main leaders, like NVIDIA, have just gotten too expensive.
That's the classic bubble warning, right?
Yeah.
But there's a counter-argument, quantitatively.
Okay.
Analysts pointed out that even after these massive run-ups, Seagate, WD, Micron, they still trade at a discount to the S&P 500 average of 23 times forward profits.
So, relatively speaking.
Relatively speaking, the argument is Seagate's valuation, maybe around 20 times estimated profits, is still attractive given the demand you can clearly see coming from the data center build-out.
Interesting. Okay, speaking of maximizing AI advantage, we saw big moves towards vertical integration this week, too.
Yeah, Apple. According to a deep dive from CNBC, Apple is basically taking full internal control of all the core iPhone chips.
Why? To prioritize on-device AI.
Exactly. On-device AI workloads. This is a huge strategic shift. They're rolling out a new custom A19 Pro chip, adds neural accelerators right onto the GPU cores.
Wow.
And they're replacing suppliers. Introducing their own N1 wireless chip, their own C1X modem.
Getting rid of Broadcom and Qualcomm in some areas.
Right. Apple VP Tim Millett, quoted in the sources, basically said this total control lets them build the best on-device AI capability.
So better efficiency, responsiveness, battery life, total control of the experience.
That seems to be the goal. And the race for speed in AI hardware, it also heated up in memory.
Ah, Samsung.
Samsung, yeah. Their shares jumped over 5% after Bloomberg reported NVIDIA approved Samsung's 12-layer HBM3E memory chips.
HBM3E, high bandwidth memory.
Exactly. Critical stuff. It dramatically speeds up how fast data moves between the processor and the memory.
So Samsung getting NVIDIA's approval is a big deal.
Huge validation. It positions them to compete head-to-head with SK Hynix and Micron in supplying this absolutely critical component for NVIDIA's top accelerators. They're officially ready for the big leagues in the AI supply chain.
Okay, now for that tricky transition we mentioned.
Mm-hmm.
Because maximizing AI advantage, it isn't just about chips, is it?
Nope. Critically, it relies on talent. The best global talent.
And that's where the market got hit with a major immediate policy shockwave this week.
The proposed H-1B visa fee.
Right. President Trump's plan for an annual $100,000 fee per H-1B visa. That caused massive anxiety.
Understandably, CNBC reporting highlighted this could be a substantial blow to companies, especially in tech and finance. I mean, they rely heavily on skilled immigrants, and about 71% of H-1B holders are from India?
Yeah. And the market reaction was instant, measurable.
Oh, yeah. Indian IT outsourcing firms, TCS, Infosys, Wipro, HCL Tech, their shares dropped immediately.
India's Nifty IT index plunged nearly 3%. This wasn't a slow burn. It was like an instant repricing of risk.
Just based on the policy announcement, Citi research analysts noted this hike just drastically increases the cost of business. It's going to squeeze margins for IT service companies and, ultimately, their U.S. clients.
So what do they do?
The prediction is firms will adapt. They'll focus more on nearshore centers, think Mexico or Canada, or they'll just offshore even more work back to India's own global capability centers.
So it's basically a heavy new tariff, but on skilled people.
That's a good way to put it. A tariff on human capital.
And the shockwaves go beyond just staffing costs, right?
Definitely. JP Morgan analysts highlighted the broader impact. They think this fee will likely cut down on remittances sent back to India.
Money sent home by workers.
Exactly. And it could even discourage Indian students from choosing the U.S. for grad school, which impacts the future talent pipeline.
Wow. Okay, adding to this whole theme of geopolitical caution, we saw a huge symbolic move from the investment world this week.
Berkshire Hathaway, selling BYD.
Fully exiting their stake in the Chinese EV maker BYD.
An incredibly profitable stake.
Hugely profitable. Championed by Charlie Munger, yielded something like 3,890% over 17 years. Insane returns.
But according to the CNBC Buffett Watch newsletter, this follows their earlier sale of Taiwan Semiconductor. There's a pattern emerging.
It really connects back to what Buffett said in 2023. It's a dangerous world.
So when a firm famous for buy and hold forever decides to completely liquidate such a successful position, it sends a really powerful signal, doesn't it? About the perceived geopolitical risk of large cross-border investments, especially in sensitive tech sectors right now.
And that caution seems reinforced by what's happening inside China, too.
Right. Despite the U.S. Fed cutting rates, The People's Bank of China kept its key loan rates unchanged.
The 1-year and 5-year loan prime rates stayed at 3.0% and 3.5%. Another CNBC report covered that.
China's holding tight. It signals the PBOC isn't rushing into major stimulus, even with signs of economic fatigue showing up.
Like slowing retail sales, easing industrial output, deflation.
Yeah, persistent deflation in wholesale prices. So while the U.S. market is having its honeymoon rally, China's signaling stability and control despite internal pressures.
Okay, let's pivot one last time. Let's look at Europe. They seem to be trying to stage a financial comeback amidst all this global tension.
There are definitely signs of life there. After a real slowdown, there's a clear IPO revival happening.
CNBC called the September IPO activity the quarter's standout story.
We're seeing some significant listings. Swiss Marketplace Group floated. And there are planned listings for Noba, the digital bank.
That's valued at $3.7 billion.
Yeah, and Eurasia, the security firm. Reuters reported this activity is actually attracting fresh global investor interest.
As a diversification play, away from the pricey U.S. market.
Exactly. A genuine diversification strategy. And the big draw is valuation.
Europe looks cheap compared to the U.S.
Significantly cheaper. The STOXX 600 index trades around, 15.6 times forward earnings? Compare that to the S&P 500 over 25 times.
Big difference. Plus, you have fiscal drivers like Germany's big infrastructure fund.
The 500 billion fund, yeah. And the Eurozone pledging to boost defense spending. That combination of value and stimulus is looking tempting.
There's always a but. This comeback is already facing threats from policy uncertainty elsewhere.
Yeah, this was fascinating. An ECB study found Eurozone consumers are already changing their spending habits.
In anticipation of potential U.S. tariffs.
Exactly. They're already switching away from American products and cutting back on discretionary spending overall.
Before any tariffs are even implemented. Wow.
It really highlights the chilling effect of just policy noise. It can undermine recovery before anything concrete even happens.
So, wrapping this all up.
Yeah.
What does this mean for you, the listener? We've got this really fascinating, kind of volatile split.
Dichotomy is a good word for it.
Yeah. The U.S. market is flying high on AI hype and that Fed rate cut, pushing even boring tech like hard drives to crazy valuations. But at the exact same time, we're facing these huge, measurable policy shocks. The $100K visa fee shaking up global IT.
Geopolitical caution-making, even legends like Buffett pull back from major Chinese investments.
It's a weird mix.
It really is. And the immediate thing we're all watching now is the PCE inflation data. That comes out Friday.
That'll be the real test, won't it? Whether that Fed cut was justified.
Absolutely. If inflation comes in hotter than the 2.8% forecast, that's selective hearing the market has right now.
It might just disappear.
That could force a reality check on those high valuations very quickly.
And finally, as we close out this deep dive, think about this kind of unusual common ground between Warren Buffett and President Trump.
On quarterly reporting, right? I saw that mentioned in one of the CNBC sources.
Yeah. Trump wants the SEC to allow reporting just twice a year. And Buffett, along with Jamie Dimon, has argued strongly for companies to stop giving quarterly earnings guidance.
Their shared concern, fundamentally, is that this intense short-term focus on hitting quarterly profit targets, especially driven by guidance, it actually harms long-term strategic thinking and investments.
So it raises a really important question for you to think about. How much of this current AI-driven volatility, this valuation stretch we see everywhere in tech, how much of that is actually fueled by this super short-term market focus?
And what will the true long-term structural value of these AI innovations actually be, once the inevitable speculative excitement breaks or cools down?
That is definitely something worth exploring further, and that is the thought we leave you with today. Thank you for joining us for this deep dive into the major financial magazine headlines. We'll see you all tomorrow morning with new headlines from major financial magazines.